We have a flattish finish for the local markets on Friday. Reasonable gains, though, for the year as a whole, with the all-share up by about 16%. So quite nice gains for 2010.
Yeah, I think 2010 was a lovely year. I think the highlight was most probably the listed property shares, which rocketed. If you look at the all-share in dollar terms, it rocketed as well due to the strong rand. So yeah, I think it's going to be interesting here looking at 2011.
Just looking at some of the valuations, though, we had the Dow Jones also gaining very nicely last year. We had the Nasdaq outperforming by 17% over in the United States. Do you think valuations are looking a bit toppy at this stage?
If you look at the S&P 500, and I like the index because it's fairly diversified and broad, I don't see it at very demanding multiples currently. I think the S&P is actually more on the cheaper side than anything else. I think the market there has built in the full risk into the market valuation. However, if you go and look at the local market, the valuations is definitely getting stretched, and we need to see the numbers coming through, and we need to see the world growth momentum at least maintaining the expected pace over the next 12 months or so.
Well, in the meantime, we've had news coming out of China over the weekend. First of all, the PMI number coming in slightly worse than expected. We also had an interest rate increase in China on Christmas Day, up by 0.25%. And that was really what the market was worried about in the run-up to that Christmas period. Do you think this is going to put the brakes on growth in China and perhaps push our markets lower going into the new year?
I think it's already putting the brakes on Chinese growth. They've been very proactive in the way they manage the economy. I mean, they've hiked their capital requirements for banks a couple of times now over the past couple of months. They had the rate hike. They've been intervening in the market, especially the property market. The inflation is definitely a bit of a problem. It popped above 5% in November. And it's due to internal consumer demand. So if we look at the PMI numbers that came out this morning, it's expecting a slightly softer China, although still very, very robust growth. So over the year, we can expect, say, 8.5%, 9% growth. I think there's a little bit of an inflation risk in Asia due to the demand environment that they have there. And I think, yes, we're most probably going to see more interest rate hikes coming out of China.
How about moving over to the other side of the world, to the United States? Of course, we're getting non-farm payroll numbers coming out later this week, and that's going to be a key number to look for because the previous reading in October was a disappointing number. Do you think the US is back on its feet at this stage?
Yeah, you've got to look at the US economy in a very, very careful manner, especially the job side. I don't think we should expect the unemployment number to correct itself back to the 4% that it was a couple of years ago. It's currently above 9. It's most probably going to stay above 9 for the next year or so and then slowly come down. I think the way that corporate USA is employing currently is very focused on part-time. They are pushing productivity and they're trying to maintain margin. And slowly, as the economy repairs itself, we will see the employment numbers improving. I think what is very important, especially for consumer psychology, is where people are employed, that they don't see further retrenchments down the line, which would be good for consumer spending over the next year or so.
Well, bringing it back home, you said our market looking pretty stretched at these levels. Is that across the board? Are there still some sectors, in your belief, that are offering value going into 2011?
Yeah, I think what one's got to do when you look at a market like we have currently is, if you look back at 2004, 2005, as we went into the previous bull market, you would expect multiples to expand. You expect a lot of good news. What is very important is that we start seeing that good news materializing, especially if you look at the consumer-focused area where stocks are a bit stretched. We would like to see a little bit of credit growth. The numbers we saw earlier in the week or last week wasn't that great. I think the export-orientated businesses, even with the rand as it is, like the Billitons, diversified ones, or Anglos, still look very attractive to me. But then maybe one must look at the defensive side as well. Tiger brands, maybe a bit more industrial, and keep the defensive nature in your portfolio. I think slowly the credit growth numbers will improve, although I think both the consumer and the banks are very careful in the lending patterns.
Of course, we did see banks coming under a bit of pressure towards the end of the year, particularly Standard Bank, after it's announced quite a big retrenchment program. Do you think we're going to see the banks bouncing back as we head into 2011? Is the worst past for them in your view?
I think you've got to be very selective when you look at the banks. Maybe you've got to rather look at something like FirstRand than Standard. I think the banks are really going to struggle to grow assets, and the earnings will come through as their credit quality on their book improve. Maybe one wants to shift a little bit towards the insurer side. I think Old Mutual itself is very cheap, although you need something to prompt the re-rating there. The Standard Bank retrenchment is impacting on the broader investor market as well. We all would love to see the productivity, but what's the cost going to be when you need to re-employ in a year or two's time? And I think Standard Bank is also struggling a little bit. They've got a lot of capital, especially offshore, and with the currency as it is, I don't know. I don't think that's the greatest area to be in. So if you look at it from an ROE point of view, you want banks that are slightly more lean. Just Stephen Kosseff talking at the end of last year at Investec that they are going to stay conservative on their capital holdings, and they need to see how Basel III pans out. So the banks, I don't think we should expect them to rocket, but I'll rather focus on the FirstRand, which is definitely a bit more focused bank after the unbundling.
Do you think following that unbundling that we could see more unbundling coming through from FirstRand, perhaps dressing FNB up for sale to a potential buyer?
I don't know. It's always a probability that there's M&A activity in something like FirstRand, and they might be setting it up. But if you look at the Nedbank M&A, it's really a punt. You've got to be very careful driving your investment decisions by something like that. I think what FirstRand did well is they started focusing their businesses. I mean, if you look at the broader business, the RMHs, how they are focusing their businesses, it all goes back to the RMB boys who I think has developed very skillfully and well a business, and is seeing the areas that needs to receive attention, and it's giving it the attention the way the market wants it. So M&A is a possibility, but I think you've got to be careful positioning yourself purely on that.
Eugene, your outlook for commodity prices for 2011, of course, that very important to some of those big diversified miners such as BHP Billiton and Anglo American. What's your outlook for those prices?
I think over the short term, we've got to be very careful. If you look at metals like copper, it spiked very aggressively over the past couple of days, week or so, and it's due to technicalities. It's actually supply problems. But if you look at it from a broader sense, the Asian economies are growing very strongly. The US is slowly kicking in. So I think world growth momentum is picking up at a very slow pace, but it's picking up. And I think one should expect your commodity prices rather on the stronger than the weaker side. I think especially on oil, we're most probably going to see oil in the upper 90s, possibly over 100. The guys were talking about it this morning in a year and a half's time.
And your outlook finally for equities for 2011, do you think we can match the performance we saw in 2010?
Yeah, I think you've got to be in the local market little bit conservative. I still prefer to play it in a bit more defensive mode. We had a tremendous year. I don't think we should expect the same kind of performance. Most probably what we want to see is earnings growth coming through. So if we get anything between 15 and 20% total returns, I'll be more than happy.